Welcome to the Cashflow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cashflow Project. I'm your host, Duke Ong with Tri-City Equity Group. Cost segregation is a strategy that commercial real estate investors use to maximize tax savings through bonus depreciation. With me is my co-host, Matt Callahan.
Good morning, Duke. Today we're going to be talking about why depreciation isn't necessarily a bad word, how you can use a cost segregation to increase your tax write-offs and increase your cash flow, which we know, and at least in our industry, real estate investing drives the property value by increasing your net operating income. And the way that the cost segregation is done and who should use it and how it's done.
Today we have a special guest, Yonah Weiss. Yonah is a powerhouse with property owners' tax savings. As business director at Madison SPECS, a national cost segregation leader, he has assisted clients in saving tens of millions of dollars on taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. He's a real estate investor and host of the new podcast, Weiss Advice. Yonah, welcome to the show.
Thank you guys so much. It's a pleasure being here with you.
All right. So for those who haven't heard about cost seg, can you take a few minutes and give our audience a quick primer on what that is and how investors can benefit?
Absolutely. Well, before we get into it, let's just define depreciation. Because cost segregation is really just like an advanced form of depreciation. Okay, so depreciation, and just to give you a background, it's a really weird name the IRS gave to being able to claim the depreciation deductions out of every little piece of the building as opposed to the building as a whole. Okay, so that's in a nutshell what it is, but I'll break it down once you understand what depreciation is in the first place. So, when you hear the name depreciation, what do you think? Duke, Matt, what do you say? If you don't know anything about, if you don't know about, real estate taxes, you just hear the depreciation. What does it sound like?
Yeah, I certainly want to put my money, I would not want to put my money into a real estate asset and then start talking about depreciation out the gate. That would scare me.
Right, exactly. So depreciation, by definition, textbook definition, out of context, of course, of taxes, means something going down in value. Okay, the opposite of appreciation. When you buy a property, you want it to go up in value, right? Depreciation, but when the IRS uses this term, it uses it in a borrowed sense. Okay, so the IRS gives a tax deduction every year when you buy a property. Okay, every kind of property excluding your personal residence. So if we're talking any type of investment property, any type of business property, okay, you get a tax deduction, meaning you're able to write off the entire value of the building, the entire money that was spent, not the value, but the money that was spent. So if you bought a building for $1 million, you can now write off $1 million from your taxes, okay? However, there's a couple caveats to that. Number one is you can't depreciate the land. So you have to subtract a small amount for land value from the get-go. Okay, whatever's left over, that amount you can write off. But it takes a long time to get those depreciation deductions, meaning the IRS says you can write off the whole value, right? $1 million, but you have to do it every single year for 27 and a half years, a little fraction of that, or 39 years if it's a commercial property. So essentially the IRS is saying, hey, we're gonna give you a tax write-off, okay, tax deduction from your income taxes based on the principle that the building's going down in value, okay? So you get to write off a little bit every single year. That's what depreciation is. And it's a deduction, probably one of the greatest gifts the IRS gives to a property owner because they say, hey, it's free tax deductions. And this is probably one of the ways that, real estate investors are able to have so much cash flow and be able to reinvest their money. And that's, a wealth building strategy within real estate. So that's depreciation in a nutshell. Okay, so we get that it's like a borrowed sense of the word. It doesn't really mean it's going down in value, but it's based on the fact. And the proof of that is this depreciation starts the day that you get to start depreciating, taking those tax deductions for 27 years, starts when you buy the property. Okay, not when it's built, unless it's a brand new building, you knew the constructing it, then that's when it starts. However, as soon as you buy a property, that's the day it starts. So if you buy a property 10 years ago for $1 million, you're writing off a little bit every year, okay, $25,000, $30,000 a year, right? But you go ahead and sell that 10 years later for $5 million, the new buyer starts the whole schedule over from scratch based on $5 million. Okay, so it's really hypothetical in that sense that it's not really based on the property going down in value, and it's really not based on an intrinsic value. It's based on whatever money was put into the property, okay, however much was spent. And that's essentially, that's what depreciation is, okay? So cost segregation is just an advanced form of that, okay? It's literally like it sounds. We take the cost that you spent and we segregate it, we break it down into different components, and we say, hey, yeah, the structural component actually depreciates on a 27-year schedule, 27 and a half or 39-year, but there's stuff in the building like personal property, which is considered anything that's movable or anything that's not part of the structure, like carpeting, furniture, fixtures, appliances, equipment of any kind. And there's so many a dozen different categories of things. All that stuff actually depreciates, again, over a 5-year schedule. So you get to take that as a tax write-off, the value of all that stuff when it's added up, and take that tax write-off over 5 years. So you don't have to wait that long. So this is really the main thing of what cost segregation is, taking those tax deductions and front-loading them, be able to take them earlier on.
Got it. So who should use a cost seg study?
Really anyone who wants to maximize their tax write-offs. It's not necessarily for everyone, because you may have some people that may not want to maximize their tax deductions. Okay, if you, for example, if you can't use those tax deductions, let's say you already are losing money on the property. Okay, it doesn't have income. Let's say you buy a piece of vacant property and there's no income coming from it. So taking a tax deduction when those deductions can only offset the income, you don't need it. That's probably where it's not going to be a good idea. But pretty much almost any other real estate investor who is buying a property for over $1 million or even over $500,000, I would say, and you're planning on holding it for more than 2 years.
Why the $1 million or $500,000?
Sure. So because it's a principle, what we described is we're taking a certain percentage or a certain amount of the property and we're accelerating that depreciation over a faster life, but it's proportional. Okay. So for example, a multifamily property typically has, around 20% of the property can be accelerated to a faster life, somewhere between 20 and 30%. So if you have $1 million property, okay, subtract a little bit for land, you're talking about maybe $200,000 of accelerated depreciation, okay, that you can take over a 5-year period. That's an extra $40,000 a year, right? But under $500,000, you're talking about an extra $20,000 a year for those first 5 years. And if it's less than that, it's even less. So if you're going to spend a few $1,000s to get the study done, which is usually the cost at the very minimum, then it's proportional. That's why I say the benefit is going to be less when the property value is lower.
Got it. Okay, so why would someone perform a cost seg when the depreciation is recaptured at exit?
Oh, that's a great question. So the main principle of cost segregation is the time value of money. Okay, your money works better in your hands than it does in the IRS's hands. Okay, and this is a paradigm shift that a lot of people need to think about. Even before I get to describe what depreciation recapture tax is, there's something that, especially corporate America, we think we have to pay income tax. It's deducted from our paycheck. Okay, we make money, we automatically have to pay. Doesn't matter, no matter what, right? But the paradigm shift is in real estate investing, if you can create deductions that offset all of that income, then any money that you actually make, you can keep in your pocket. If at a later point, a year, 2, 5, 10 years down the road, you may have to end up paying those taxes at that point, that's a whole separate story, okay? You got to think about that, sure, in the overall strategy, but at the same time, your money works a lot better in your hands than just giving it to Uncle Sam when he doesn't require, you to do so. So some people think of that like an interest-free loan in that sense, because maybe you have to pay it back. But I'll ask you a question. You know, if someone offers you, hey, I'll give you an interest-free loan for $100,000, no interest for 5 years. In 5 years, you're going to have to pay it back to me in installments over the next 22 years. Okay? Also interest-free. So the question is, you know, who wouldn't take those terms? I think like anyone would take those terms and try to get more, you know, like, oh, will you give me 200,000? So that's really the point where it comes in. But I like to think of it more than that, because it's not an interest-free loan. It's your money in the first place. Okay. When you make that money, it's your money in the first place. If you have that cash flow, you can reinvest that into your properties. Now, don't get me wrong. Recapture tax is something very serious that you need to consider when you are buying a property. You have to think about, when's my exit strategy? If I'm going to sell it in 5 years, whatever amount of depreciation I take, I have to pay a tax on that amount upon sale. Just like when you sell a property and it makes a gain, right? It goes up and you sell it for more than you bought it for, you have to pay capital gains tax, to pay a tax on the amount, that difference of what you bought it for versus what you sold it for. So too, at the point of sale, you have to pay a tax on the amount of depreciation deductions you took. So sure, you're taking more deductions now, you may have to pay later a lot more because you took more. But again, it's still going to be 25% as opposed to your original income tax rate, ordinary income tax rate that you would have paid if had you not taken those deductions in the first place. So not only do you get that spread of, you know, the arbitrage, if you will, between my ordinary income tax rate and that 25% that I may have to pay down the road, but you also get that money in your hands to reinvest, and you probably know how to spend your money a little better than the government does.
Got it. So it's not a 1-to-1. It's only 25% of that depreciation that you have to pay a tax on, right?
Well, no, it's the entire depreciation that's taxed at a 25% rate.
Yeah. So it's that difference between what it would be if your ordinary income rate is higher.
Exactly. And again, that's standard finance for you, you know, finance 101 right there.
Got it.
So you talked earlier a little bit about, you know, spending thousands of dollars. How exactly, what is the price point of a cost segregation, and does it vary if I have $1 million property or $1 billion property? I know you've worked on some pretty big projects.
Absolutely. Yeah. We've done several, you know, $1 billion plus projects, skyscrapers, you know, huge properties. The price point is not based on the tax savings. And that's something really important. There are some tax firms and there are some firms out there that will charge on a contingency. Okay. Literally, I just heard from someone that they're charging like, you know, $90,000 or something to do a cost segregation study. Literally, someone just told me that. I was shocked. So for us, you know, we try, we're the biggest national firm. We work in all 50 states. We've been to Hawaii. Even this year, we worked in Hawaii 3 times. You know, so we'll work all over the country and our prices are pretty competitive. So somewhere usually between $4,000 and $10,000, you know, it's based totally on the scope of work of the project, you know, how big it is, how much work the engineers actually need to do. So that's something I didn't mention. We have in-house engineers actually go to the property and determine what are those assets, what are those items that depreciate faster. So that's a, you know, intrinsic part of the cost segregation study according to the tax code. But again, it's that one, you know, if it's a 100-unit building, a multifamily, or a 200-unit multifamily building, believe it or not, that's where the price is going to be almost identical. It's not going to be much more. It's only when the scope of work is much more in an office building or a retail center or something like that, where the engineer will actually have to go into every unit, and every unit is different. Every suite in the office has a different build out. So there's a lot more square footage, there's a lot more suites, a lot more to go. Whereas in a multifamily property, the engineer has to go into one of each unit layout type, you know, considering that they're all pretty much the same. And that's one of the advantages that multifamily has over other properties, that the scope of work is actually a little bit less.
So for someone who might be concerned about that upfront cost on a cost segregation, Madison SPECS will come out and do a no cost feasibility analysis, right? Could you kind of maybe run through an example of what that looks like?
Absolutely. So it's not even we don't even come out at that point. We'll give the upfront, feasibility analysis. It's the free estimate, basically, based on our engineer's experience, taking a few data points. So we'll look at the address of the property, and we'll pull some public records just through the software and the data that we have. We want to look at the year it was built. We want to look at the number of units, the unit layouts, the different types of units, square footage of the property. We'll look at the price, the purchase price, because that determines what the actual basis is, how much you can depreciate. We'll look at the placed in service date. So that's the closing date, because that's when your depreciation starts. Okay. And it's actually prorated to the day of the year. So if you bought a property on December 31st, you only get 1 day, right? So basically 1 out of 365, 1/365th of depreciation for that year. Okay, so if you bought a $365,000 property, for example, then you would only get $1,000 of depreciation deduction. And then that would be split up between, the building component, the property, the personal property, land improvement, et cetera, different categories. So we'll do that upfront, and that will show you what the difference. We'll make 2 graphs. Okay, you'll see. This is what my depreciation deductions would look like this year and the next 27 years, right? And then this on this line would show me what my depreciation deductions would be if I did a cost segregation study. And in the first 5 years, you're basically seeing upfront what the net present value would be, what your actual savings would be if you would do that. So it's pretty educational. It's basically, once you see those numbers, it's basically a no-brainer. If you can use those deductions, it shows you right up front what you're going to get.
So it pays for itself pretty much the first year you have it.
Well, that itself, that study we do is free, right? That estimate.
Yeah. So going forward with the cost seg would pay for itself.
Exactly.
That's awesome. So we're all about cash flow here, obviously. How exactly, is it a tangible thing? How does a cost segregation study increase my cash flow if I'm a property owner?
So if you make $100,000 of net operating income from your property, right? After all, expenses, your mortgage payment, everything, that $100,000 is going to be, first of all, you get the depreciation deduction, straight line depreciation, which, let's say it's a $2 million property, okay? $2 million property, $100,000 net operating income. $2 million property, you're gonna get about a $60,000, I'm just estimating here, about $60,000 of tax write-off as for regular depreciation, which means you're gonna have left over $40,000 that you're gonna pay tax on, okay? If you're paying a 30% rate, right? 25% rate, you're going to pay $10,000, et cetera. The depreciation, the cost segregation will come in and create more deductions in those first 5 years. Like I said, an extra $200,000 per million, approximately. So an extra $400,000, that's an extra $50,000 a year. Okay, that will take your net operating income, reduce it. Those tax write-offs will reduce that to zero liability. So you're going to pay zero income tax. Right, this year and next year and the following year. So what that does is that increases your cash flow because you're paying less income tax. And for passive investors as well, because if you invest, $100,000 into a property, into a deal, and you're getting, let's say, an 8% return, that $8,000 that you're getting in return in any other type of investment vehicle, you'd be paying a pretty high tax rate on it, right? With cost segregation comes in, creates losses, creates that your income is now, for the first 5 years, essentially tax-free, which means that's more money in your pocket.
Pay for losses, not realized losses, right? So that's good.
Correct. Yeah, exactly. Paper losses, which means that the money's really just in your pocket and it's not, sorry, I got a little feedback there. And it's not in Uncle Sam's pocket.
Yeah, we're not sharing. So pretty recently, there's some new tax laws, 100% depreciation bonus. Can you talk through that and kind of the implications of it?
Sure. 100% bonus depreciation means in the Tax Cuts and Jobs Act, which was passed approximately, in the end of 2017, 2018, the IRS came up with a new law and said that any property that depreciates less than 20 years can now, you have the choice, you have the option to take that as a first-year tax write-off. So what does that look like? When we do a cost segregation study, we determine what depreciates at a faster life. We determine, right, based on our engineer's experience, how much of the property depreciates on a 5-year schedule. Again, that's all the personal property. How much on a 15-year schedule? That's stuff like land improvements, which can include landscaping, like this beautiful, beautiful mountains behind, this beautiful tree, all this landscaping over here. This depreciates on a 15-year schedule. When the engineer comes and determines a value, a price point for each of those, all of that is added up. When you're doing a cost segregation study, you depreciate that at a faster rate. Comes in bonus depreciation and says you can take 100% of all of that accelerated depreciation, and instead of spreading it over a 5 or 7 or 15-year period, you can all take the entire amount in year number 1.
So I know with cost segregation studies, you can recover missed depreciation deductions from previous years. So how does that work? And then if I'm buying a property to reposition it, should I do a cost seg first year, or should I wait until it stabilizes? Is there a benefit to either?
Sure, both great questions. We'll take them one at a time. When you do not have to do, and really this is the answer to both questions at once, you do not have to do a cost segregation in the first year of ownership. You can get it retroactively. So if you bought a property, 2, 3, 5, 10 years ago, you can do what's called a look back study and get retroactively those tax benefits, the accelerated depreciation that you missed. So essentially what that looks like is, let's say 5 years ago I bought a property and I was taking regular depreciation every year. Okay, $30,000. Comes cost segregation and says you can get $200,000 of deductions over the first 5 years, but extra deductions. I didn't do this for 5 years, so now I do it. I file a form, not amended. You do not have to amend your returns to do this. You file a form. It's called 3115, and you do an adjustment. It's another form, and we actually do that for our clients at no extra cost. Part of our service is makes an adjustment and says, hey, we're changing the method of accounting, changing the method of depreciation, and saying, now I'm going to take that accelerated depreciation and I'm going to get it this year because I missed the last 5 years. I'm going to get it all as a big chunk in the first year. So you don't have to do it in the first year. However, to answer your second question, which really goes together with this, is that if you're doing a big reposition, you're doing a major capital expenditure on the property, it really depends, okay, on your situation. Do you need those deductions this year? Because when you're doing the renovations, you can actually double dip. You can get a double tax benefit. What do I mean by that? Because when you do a cost segregation study, you're looking at the purchase price. How much should I buy it for? Bought it for $1 million. Now you get to write off $1 million now. Next year, I'm doing, $500,000 of major renovation, putting in all new kitchens and all new, appliances and paving the new parking lot and all that stuff. All of that money that's spent now gets added to the basis, meaning you can depreciate that amount as well. So you can take not only what you were taking before on the acquisition cost as depreciation deductions, you can now take the depreciation deductions from the spend, from the capital expenditures. And usually that's a larger amount in cost segregation sense, because most times when you're doing renovations, it's not structural components. Okay, there is always going to be a certain amount there, but there's less structural components, which again, the structural components depreciate a longer life. The faster stuff is appliances, furniture, fixtures, et cetera, cabinets, countertops, all that stuff is on a 5-year schedule.
That's huge. That's huge.
So speaking of bonus depreciation, can you kind of cover the timing of like when, like for example, this year versus the next 5 years, we should be doing a cost seg study?
Yeah, you should be doing it. I mean, there's really very little reason to not do it. Like I mentioned before, bonus depreciation was written into the tax code, but according to the tax reform, starting in 2023, it's actually going to start going backwards and starting phasing out. So you're no longer going to have 100% bonus depreciation. In 2023 is going to start only 80% bonus depreciation. And then after that, 70%, et cetera, until it phases out. And we're no longer, according to this reform, we're no longer going to have bonus depreciation. So take advantage while you can, especially because with the CARES Act that happened, about a month ago, they put in a new law over there that says you can take net operating losses carry forward, okay, passive loss carry forward 100%, which they've limited before to 80%, but now you can take 100% of that, which means if you take, bonus depreciation, let's say you take a huge amount, $1 million of bonus depreciation, right? A huge amount, and you're only making $100,000 on the property, like, why would you take all those extra deductions? Well, two reasons. Number one, if you are a real estate professional, okay, which means you spend more than 50% of your time in the trade or business of real estate, then you can take those deductions to not only offset income from your properties, say plural because it really spreads across all your properties income, you can also use those deductions to offset your and your spouse's ordinary income. Okay, so if you have a spouse that's a high, W-2 earner and you're a real estate professional or vice versa, you can use those depreciation deductions to offset all of it. Or if you have a business, let's say you're a wholesaler or you're, a syndicator and you have all these extra fees you're taking, right? Those fees are ordinary income. Okay, that's not considered the passive income from the properties. So you want to be able to take more deductions so you can offset all that income as well. The second reason why you want to take it is because you don't lose it. Even if you don't use it this year, you don't use it, but you don't lose it. Okay, you get to use it next year. It carries forward with you, and you can utilize those benefits, those tax deductions in the next year and every year until it runs out or until you sell the property, whichever comes first.
Dude, it sounds like we need to buy as many properties as possible in the next 5 years.
Exactly.
Yeah,
exactly.
definitely. The time is now. So shifting gears a bit, what is the best book that you recommend?
The best book about what? Business,
real estate, taxes. I mean, anything that you think is of value to our audience.
The first thing that popped into my head is Tax-Free Wealth, Tom Wheelwright, Rich Dad Advisors, great book. And he has a section in there all about depreciation, which he calls the king of all deductions. So good book right there.
What is your superpower?
That I can be anywhere in the world just with the click of a button.
Yeah.
That's my Zoom superpower. I don't know if it's really... No, for real though, that's just something cool I like to do. But for real, I think my superpower is that I have a great ability to learn new subjects and integrate them very quickly and be able to teach them. So it's kind of I've been a teacher for about 15, 20 years. So that's kind of my skill, superpower, I guess, if you will.
Nice. What are your hobbies?
I have 6 kids. So that's basically all my hobbies right there. just spending time with them and figuring out their hobbies. I don't really do anything else besides that. I mean, if you call LinkedIn a hobby, that's where I spend most of my time. So
what is your favorite travel destination?
There's a beautiful city in Israel called Safed, S-A-F-E-D, it's spelled differently, but it's a beautiful city up in the mountains in the north. Highly recommended. Beautiful air, beautiful culture, nice place.
All right. So as we wrap up, do you have any requests for our audience, and how can people reach out to you?
Please reach out to me. You can find me on LinkedIn. That's, like I said, that's where I spend most of my time. You can find me at yweiss@madisonspecs.com. Email if you want one of those free estimates. And, we just started because of this whole COVID situation. We're not really going to many travel destinations at this point. We're not doing all these, meetups. I know we met in LA last year, a few months ago, actually, right? Mm-hmm. Rod's event. Unfortunately, that's not really happening anytime soon, any of these networking events. So I created a virtual networking event via Zoom, a real estate investor meetup, which is happening every Wednesday at 7 p.m. Eastern. And we have a different speaker and then some networking afterwards through Zoom, which is really cool. These breakout rooms on Zoom. Have you ever done that?
Yep.
Cool stuff. So please check it out on my LinkedIn over there or Facebook, whatever. Find me and come on down.
All right. Perfect. Yeah, we'll put all that in the show notes. All right. So thank you so much for your time, and we really appreciate all the golden nuggets that you provided regarding tax advice and cost seg and all that.
Wow, what a great show with Yonah talking about cost segregation and how it can help us really build wealth when we're talking about real estate, right? So we can depreciate our assets quicker, which, depreciation wasn't a bad word. We can depreciate our assets quicker to offset any income that we generate from these investment properties, which is going to really drive our bottom line. And we can roll that over into multiple years. We can spread it across other properties. And cost segregation is basically a simple tool that you can use as a real estate investor to just increase property value, increase cash flow, which is what we're all about in the cash flow project, help you build wealth. It's just one more tool in the toolkit.
All right. And if you are interested in connecting with us, go to tricityequity.com to learn more. To connect with like-minded investors, join our Facebook group, Honolulu Multifamily and More. And if you found value in this podcast, please subscribe and give us a rating and review on Apple Podcasts or Stitcher. If you know anyone who might resonate with today's podcast, please share the episode with them. See you next time.